I guess my question to you is you're bullish going into next year. What sectors do you think are going to benefit the most? I mean, you mentioned, companies that there's no place to really find yield. I won't say absolutely no place, but you mentioned 10-year treasury below 1%. Yet we have a lot, I think it's 1.7, 1.8 is the yield on the S&P 500, but you're going to find lots of companies yielding more than 2% right now, 2.5%, 3%, and good companies with a good growth profile. Once we start seeing the effects of COVID and the vaccine and more things opening up, but does that go to small cap cyclicals as well, which have made a nice comeback, but still underperforming the market? Casinos, hotels, airlines, travel related stocks that, have gotten hurt, where you saw revenues come down. And, I think people have to realize these companies are going to be stronger than ever, right? They're lean as ever. And then when you're seeing that bounce back and people travel, that revenue, they're not just going to go back to their highs. I mean, they're going to surge past those things, but is that an area you're looking in? What's some of the sectors that benefit the most?
So I'm going to answer the question a little bit differently, not in terms of sectors, but I think asset classes. So there are two asset classes that have carried the entire year. Growthy tech, right? And basically any spectrum across the tech. We wanted to, we've talked ad nauseum about large cap, mega cap tech, but also small and mid cap. Tech has really driven the horse here on the equity side. And then high quality, longer dated bonds. And literally up until, the first week in November, it was those two asset classes that drove the whole market. And then what happened in the second, or that Monday, was it November 9th or whatever it was, post the election? We had a Biden declared victory, but more importantly, you had a split Congress, right? Again, which would prevent a Biden tax increase. So the split Congress was the key, which the market viewed very favorably. And that Monday, Pfizer came out and said they had a 95% efficacy on their vaccine. And then you had Moderna come out soon after saying 94% efficacy. And then you said AstraZeneca come out and say they had a 90% efficacy. And what happened? Everything in between those two polls, everything in between growthy tech and high quality bonds started, which had a negative yield for the most part, had a negative return for the year, rallied. Small cap rallied, value rallied, international rallied, dividends rallied, preferreds rallied, high yield bonds rallied. I mean, everything in that middle. So I think in the new year, the two places that look the most interesting are yield-oriented securities, non-bond yield-oriented securities. I mean, I think, the investors are going to wake up, and if you're in retirement, you're going to realize that your portfolio is not throwing off the cash flow that it once did. You don't want to take on the volatility that the stock market brings. So you're going to embrace dividends once again. And Frank, behind value, dividends are down, are the second worst factor, performance factor this year. Growth, momentum, they're the best, but the worst performing factors are value and dividends. They're down like 25% as a factor, which to me doesn't make now. Why is that? The financials, energy, utilities. I mean, those are your traditional dividend producing sectors that make up that factor, but and they're performing poorly. But I do think dividends, investors are going to embrace dividends again as they look for more yield. And then international, listen, COVID isn't, repairing from COVID doesn't happen for free. We're printing a lot of money. We're taking on a lot of debt. It still boggles my mind that the dollar has been as strong as it has been. And, this whole wave of COVID started in the East, right? It started in China, Korea, and then made its way through Western Europe and then into the US. So, particularly China and Korea, they're recovering from COVID, and then, of course, we're hitting an air pocket here in Europe, but, if you follow that same sort of strand, international companies and countries outside the U.S. appear to be able to recover a bit quicker. So I don't think the dollar will be as strong as it has been. And I think you'll have a faster recovery outside the U.S. And listen, international has underperformed U.S. domestic for the last decade or so. And I think international stocks are quite attractive here. So those two asset classes, to me, higher dividend paying stocks and international are attractive in 21.
Okay. Now, the fun part, which is why you're one of the most popular guests, is you always offer ideas.
Mm-hmm.
So, how ways that you play this? And I know a lot of these companies are in your portfolio at Tocqueville. But what are some of the ways that investors can play this? Because there are a lot of options right now for dividend-paying stocks. We actually started a newsletter based on what we heard from our clients, because we said, okay, we listened to our customers, and they were like, we need income. We're dying for income. And we started a great income product. It's not traditional where, hey, it's the highest yield. We look at the underlying company. It better be growing. Otherwise, that yield's going to be pretty worthless if it's a 5-6% yield and the stock's down 20%. But I think there's a lot of names to choose from here. What are some of the ones that you like?
Yeah, so we have an enhanced income strategy as well, and it's tax managed, again, 35 to 45 individual positions. And similarly, what are the factors that we look into to buy a position in this portfolio? It's got to have, above 3% dividend yield. It has to have a management team that's grown its dividend annually over the past 1, 3, 5-year period. It has to have a below average payout ratio, and it has to have a strong balance sheet that it can absorb the black swan event, so it doesn't have to cut the dividend in times like we just went through. And in fact, the projected growth of the income in the portfolio from the stocks is going to be about 4% from this year to last year, from 20 to 21. So one of the names that we like, and I own it personally, is a company. It's a REIT, publicly traded real estate investment trust called Stag Industrial. The ticker is STAG. Stag is a mid-cap industrial REIT. So what do? They own and operate warehouses that benefit from e-commerce. So if you want to play the sort of the Amazon e-commerce, where we've all had that step function higher to ordering more stuff online delivered to our house, and now more people in the world are more comfortable with that. More industries are embracing that way to get, direct to consumer environment. These guys just hold the stuff in their warehouses. Trucks come and pick it up. They have a 4.75% dividend yield. They've grown their dividend about 2% annually, so pretty much with the rate of inflation over the last 5 years. They've been growing through acquisition. So they got quite timely in January of this year. They did an equity offering. So they issued stock, and they got liquidity back. So they did it at a higher price, right? And then COVID hit. So instead of using that capital from the equity offering to go out and buy, do a ton of do acquisitions, that actually allowed them to have some liquidity in a time when the capital market shut down briefly. And then as the market thawed, they were able to use that equity, and they actually went out and bought more square footage, more industrial. So they do roll up over time. They have about 470 properties in and around the United States. And so this is a way to play, and it's trading at about 16 times funds from operations. So in the REIT world, think of funds from operations kind of like earnings per share. To put that into context, Frank, you're probably familiar with Prologis. Maybe some of your viewers are familiar with Prologis. I do not own Prologis. Our strategy is not own Prologis. But Prologis is the elephant in the room in the industrial REIT space. And Prologis trades at like 30 times funds. So Stag trades at about a 40% discount to Prologis on a valuation standpoint. Now it's a fraction of the size. Prologis is a large cap company. Stag is only a $6-7 billion company. But why can't Stag have a higher multiple, or multiple closer to Prologis? They recently issued a press release for 2020. Their net operating income is going to come in higher than previously forecasted. And the final trend here is, if you think post-COVID that we're going to have more onshoring of U.S. manufacturing, where we're not going to deal with exporting and further contact that cause supply chain issues, and companies are going to want to reduce the supply chain logistics for delivering their products. Well, guess what? You're going to need more warehouses and industrial space in the U.S., which suits Stag and the industrial REIT space quite well.
Yeah, I love the single tenant part with industrial. Because there's some REITs that are different, really into commercial real estate. In major cities that might not come back as quick. But even when I look at the chart, what I like here is that it's not even at pre-COVID highs yet, right? So you might say, well, it's not at highs, and again, this is something that has underperformed if you look from the year compared to everything else. But when you look at some of these technology, Nasdaq is up 20 whatever percent now, right? So companies like this, and just get No,
this comes into play. If you look at the VNQ, Victor Nancy Queen, that's the Vanguard REIT ETF. So when you say it's underperformed, well, you have to look at it within the sector, right? So the entire REIT space has been terrible. So, but this goes back to my point that what has the market favored this year? It has been growth and tech, right? It has been, and more recently cyclicals. If you paid a dividend, right, and you were a REIT, you underperformed, and this stock is outperform. It's still slightly negative on a total return basis for the year, and that's about a little bit better than the VNQ. But again, nothing to write home about when you're down mid-single digit or low single digits. So my point is, I think that this yield play reflates, and investors get more comfortable back into those companies that are paying out above average dividend yield, because with COVID, hopefully, or eventually, sooner rather than later, in the rearview mirror, we're able to turn the corner. Investors will be less worried about people's liquidity and will start embracing it and wake up to say, well, I'm not earning anything on my cash. I'm earning nothing on my bonds. Maybe I should start looking to stocks with above average dividend yields. And I think Stag has a very good long-term trend in its back in terms of being an operator of e-commerce. Amazon, by the way, is its largest customer, but it's only 2% of Stag's total revenue. So just goes to show you how diversified the business is. And yes, they're a player with Amazon, but whereas Prologis, Amazon is a much bigger player for their total revenue.
Yeah, one thing that you did say is when it comes to your dividend fund, is it mandated? One of the things I think you say is you look for companies that raise their dividend past 3 to 4 years. And I'm thinking, because there are a lot of companies that really played it safe, right? They had to lay off employees. Some of them were able to furlough, and then they went to layoffs, whatever. But they cut costs dramatically, so they're much more lean businesses, and that resulted in some of them cutting their dividends. And now, in the last quarter, they not only reinstated them, but they reinstated them, I think, 2 quarters ago. And now they raise their dividends because business is booming. Have you ever looked at those? Because it seems like there's a lot of hidden gems there that you might be able to find compared to just looking at a lot of dividend aristocrats and things like that, which, hey, if you bought Exxon, good for you. At the bottom, you should be doing well on a safe company with a nice dividend, right?
Yeah, so definitely. So we don't screen those companies out. The question is, by cutting the dividend, what did they do with their liquidity to repair the balance sheet, to make sure that, if and when the black swan event happens again, they don't have to cut the dividend ever again, right? So, there's a lot of those plays in the retail space, retail apparel space. We don't own this, but Kohl's is one of those, right? That cut their dividend and the stock went all the way down and then it's rebounded quite strongly. And, we want to look at the underlying company fundamentals. And, so I would say, yes, they're on the radar. They're not screened out, but, to me, if there's an attractive company that did not cut its dividend during all this time, and the valuation is attractive and it has underperformed relative to the market, to me, that's sort of icing on the cake.
And I'm going to ask you a question, a little off topic here, because something that we normally don't talk about much, but everything that you said earlier in terms of why the market's going to scream higher in 2021, that's my word, screaming, but, go higher, you're bullish, I'm bullish on the markets. But all the factors that you said when it comes to low interest rates, more spending with the Fed that's probably anticipated, not just from the U.S., but central governments all around the world. Are you looking at gold or even a Bitcoin in terms of your portfolio where, look, everybody's talking about Bitcoin right now, but you did have, Square invested in it a while ago, then you have PayPal, now you have some of the biggest investment legends, who didn't understand it suddenly in it. And now you're seeing companies with that cash balance, which I actually think is actually crazy, right? I mean, the cash balance are in Bitcoin now, and companies are going up like tremendously because of that. But are you looking at these alternatives? Because really quick, when you look at the large cap gold stocks like the Newmonts and when you screen for those in the Barrick Golds, if you just take those names out and you look at their growth, they look like software companies. I mean, the margins are incredible. They're producing for less than 1,000 an ounce. We're at 1,900 almost. Massive amount of cash flow, raising their dividend, and they're growing those earnings tremendously, much, much faster than the overall market and trading at market multiples. So, or cheaper than the overall market. But does that come across at all, or is it kind of like, no, not really?
Yeah. So a couple things. So we typically run balanced portfolios. That enhanced income strategy that I mentioned is a portion of our client portfolios. We also, invest in fixed income and core equity and those things. So, but within our core equity strategy, we usually have a 2 to 3% allocation to gold. The idea behind gold is, been doing this a long time. Trying to value gold is really hard. Gold doesn't produce anything. It doesn't kick off any cash flow. So, it's not a company per se that you would invest in. However, I've been through enough black swan events in my career to know that I'm smart enough to know I don't know what the future holds. And because of that, having an allocation to gold in a portfolio does offer some diversification for client portfolios. Now, where does gold get crushed? It's in the scenario that your question you asked me earlier was sort of the rate of change on interest rates. If inflation spikes to 8% and the Fed puts the brakes on the economy and, they're now increasing, I'm not forecasting this, but they're increasing interest rates from 0% today to, 5% of the Fed funds rate by the end of 2024. Guess what? Gold's going down. We saw that. Look what gold did in 2016, 17, and 18 as the Fed was increasing interest rates 25 basis points. Gold, it took a long time. It basically took, the Fed to cut rates again and COVID for gold to get back to, where it was post the financial crisis. And it really all the way back to where it was in the European debt crisis in 2011. So the long-winded way to say, our team specifically within Tocqueville does not make a call on gold, but we do have it as a portion of our overall asset allocation to help diversify client portfolios.
So, John, I'm familiar with your company, Tocqueville, but I bet you a lot of people might not be. Talk a little bit about it. I always like to give you time. There's a company that, I know you've moved to recently that you're extremely happy with. Talk about that, Tocqueville, and if people want to learn more about you, how can they do that?
Yeah, thanks, Frank. Yeah, so Tocqueville has been around. We're celebrating our 35th year. We've been around since 1985. We manage about $7.5 billion in assets for clients. The team that I'm on, we manage about $1.5 billion for clients. We manage for individuals, families, institutions, family offices, and we are. Our approach is very plain vanilla. And what I mean by that is we sit down with each client, each institution. We figure out what their financial goals and objectives are. What are they trying to achieve? And then we build out a portfolio across our strategies, of which are core equity, taxable fixed income, tax-exempt fixed income, and of course the enhanced income strategy, which I mentioned. And we typically diversify across client portfolios. We manage for tax efficiency, so we buy individual stocks. We harvest losses at year end. If there's an income-producing security that is not bad to hold in a taxable account, we'll hold in a tax-sheltered account. And we want to be all of our clients' sort of go-to person as a financial advisor and wealth manager to preserve their savings, to preserve the money that they've earned, and to grow it for future generations. Because, Frank, at the end of the day, whether the stock market goes up next Tuesday or if gold goes down 3 weeks from now, at the end of the day, the biggest risk that you and I and everyone else faces is outliving our money. The last place you want to be is, we're all living longer, and the last place you want to be is 85 and you're running out of capital. That is the worst possible situation to be in. So we try to build client portfolios to make sure that that never happens.
Yeah, great stuff in Tocqueville. My biggest question here is, Man, you look pretty good there, pal. That's a nice picture of you.
Oh yeah, listen, that's all pre-COVID. That's all pre-COVID. So that's probably 15 pounds lighter. That's a lot of gray and white hair less than I am now. So but I appreciate that. And then Frank, if any of viewers want to catch me, I'm on at J Petrides 2. That's my handle on Twitter. That's my handle on Instagram. Hit me up on LinkedIn. All my contact info is on the website if anyone needs anything. I'm going to be on CNBC on December 29th on the closing bell. And there's some schedule for that now. And that's that.
No, I was just going to ask you if you have the TV appearances coming up or anything. So, because I know I love watching on TV. I just love how you dial down.
I appreciate it
for people. You're very, very sharp, very good, and honored to have you on the podcast. You've been a good friend.
Same here.
Talk a lot about that during the podcast. But I got one last question because we are actually going a little bit longer than expected. But great information, and thanks for the picks and everything. Analysis. Who's going to win the Super Bowl? Seemed like an easy question maybe a month or two ago, but, I guess now it's a little different with Kansas City. Actually, it doesn't look that good. They almost lost the past couple of games. I think they're beatable, but obviously they're the favorite. But who do you think?
That is, the odds makers have to say Kansas City. If there's 2 minutes left in the game, you don't want the ball in anyone's hands with Mahomes and having all those weapons. That is really tough to beat. Pittsburgh has really tipped their hand, which opens the way for Kansas City. I think. You know who could be the ultimate sleeper in all of this is Tennessee. They have a pounding running game. They have a good defense. They've been destroying teams. A.J. Brown is an absolute monster. And if Tannehill has proven, basically 2 seasons now that he could be mistake free. He could be a good game manager and make plays when he has to. So, so I think Tennessee is really attractive, and maybe Green Bay. I would like to see Rodgers get one more crack at a Super Bowl. I don't
know if it's weird how no one's. It's weird how no one's really sold on Green Bay, right? Even though they're putting up the numbers, they have the best record, and I think New Orleans starting to trail off a little bit, but. It's not a sleeper anymore, but man, Buffalo has been playing lights out. When you have a good defense in every game, and man, that quarterback is just confident as ever and looks fantastic. So, I'd throw Buffalo in the mix there too. But yeah, it does look like Kansas City. I'd love to see Buffalo.
All right, Frank. If this isn't a financial talking head, hedge my comment on this question. I'm going to say this: I think someone from the AFC is going to win the Super Bowl.
You know what? It seems like that, right? That's what we're talking about, all AFC teams, right? And then we got Green Bay. But, it's weird how it plays out. Because if everything plays out the way the season is, where, Kansas City look unbeatable, then they got crushed by Vegas. And then the last 4 or 5 games they haven't covered. It's been close. Let Miami come back too. And then New Orleans. And then you have... just Green Bay out there, I'm not too sold on again, but it's if everything plays out as is, Buffalo will probably lose their next game, right? I don't think they play anybody good this week, but they're probably going to get blown out, right? Just like Pittsburgh got blown out when you thought they were great. It's just these teams, the Saints lost to the Eagles. It's just weird this season. It's just, you can't get a read
It's true.
I don't know.
The one team where the football gods need to shine some light on is New Orleans. They've lost the last 2 years on just, or whatever it was, the last 3 years. They were just, terrible pass interference call. The guy misses the tackle on the last play to Stephon Diggs. It's Drew Brees' last year. If there's one team that you want the fantasy gods to let the ball bounce their way, it would be New Orleans, right? So,
Anyway. Makes a lot of sense. So listen, John, thank you so much for joining us. Thanks for the long interview. Thanks for the picks. Thanks for everything. And you and your family have a wonderful holiday season, and stay safe.
Thanks, man. You too.
Enjoy it. All right, man. I'll talk to you soon.
All right, be well. Thanks a lot. See ya.